Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our expert Sangeet Lakkar of Newberry Capital and T.S. Harrier. He joins us of HRVB Client Solution. He joins us on the phone line today. Excessive traffic today, but the show has to go on. But on the show today, we discuss Reliance Industries and its prospects post Jio's new broadband announcement. We ask our analyst friends what they make of it. We also talk about Infosys. While the markets haven't done too well in the past, Infosys has made a 52-week high. We discuss what's working for the company. Two stocks which have actually moved up significantly. First of all, it's Shankara Building, which has managed to move up significantly. After the start of the year, it fell to almost 250, and then post this, there's been a big bounce back that has come in. And the last stock that we want to talk about is the new listing, that is IndiaMart Intermesh. We discussed the long-term possibilities of the company. It's up almost 25% in the last two trading sessions. But before we speak to our analyst, let's bring in Soumit Sarkar, who gives us 5 key takeaways from the JioFibre rollout, and then we'll discuss what exactly has one to do with Reliance Industries. Soumit, give us some takeaways from what happened post the announcement of that. What have brokerages been saying? What's your view on the entire thing?
Well, the brokerages are saying that the JioFibre plans are priced lower compared to its peers with better speed, but the data allowance and the content offering that Jio has given on its plans are lower compared to its peers. Also, the price per GB is better for peers like Airtel compared to that of Jio. Now, the cable TV is not being provided with these plans, so that's one thing positive coming out for the DTH and the cable players, as this TV has not been bundled in these plans. Along with this, another positive thing coming out of this for the movie exhibitors, that is PVR and Inox, is that the first day first show is only available on higher monthly plans, that is for 2,499 to 8,499 plans, and the offtake of these plans would be limited. So as such, not a big impact coming in for PVR and Inox. Along with this, the analysts are also saying that the Jio's wireless, that is the mobile plans, when they were launched 3 years back, had a differentiated product offering, better pricing for consumers, which is currently lacking in the JioFibre plans that have come out, because of which the expansion of the fiber market or the home broadband market could be limited, and its target to reach the 20 million homes could be a bit delayed. That's what the brokerages are saying from the Jio broadband plans that have been announced a few days back.
Okay, thanks so much for that, Soumit. Sangeet, I'll come to you first. What did you make of the announcement of Reliance on broadband? Firstly, we'll talk about that, and then we'll talk about the stock as such.
So clearly, I don't think it's disruptive in the manner in which the wireless rollout was 3 years earlier. Also, if you see, the market size of the broadband is extremely small as compared to the wireless network, in the sense even after 10 years of launch, Airtel's annual revenue from this business is hardly 6,000 crores, and same is the case with Dish TV. So, and if you compare with Reliance as a company, so and looking at the current plans, I don't think they intend to make it their mainstream. In any case, the market size is small, and they haven't done a very disruptive kind of launch, which the street was expecting. So I think, it will create some noise. They'll increase the market size to some extent, but not a significant event as such for Reliance, I would say.
But do you think that it's a couple of other companies, like let's say like a PVR, who was there's no clarity on the first day first show, or companies like Airtel and Dish TV now will be in more focus, and they will breathe a sigh of relief of what's happened, because everyone was anticipating this to also be extremely disruptive, but it was disruptive but not disruptive enough.
Yeah. So obviously PVR is, over a period of time, will face challenges from other disruptive platforms, and it is already facing maybe from Netflix or Hotstar or likes of that. Bharti Airtel again has a very small component, hardly 10% of revenue coming from this vertical, to create any impact on the consolidated earnings. But I remain cautious on PVR, not because of Reliance Jio launch or no launch, but because of the environment going forward, the way we see it.
Okay, I'll come back to you. Let me get Hari in. He's joining us on the phone line. Hari, what's your sense on what's happening with Reliance, the announcement on the GigaFiber? What did you make of the entire thing?
See, I think optically it does look good, because about 2.5 years back, you had the a wireless service which was priced dirt cheap, and then now you have a All India JioFibre kind of announcement. So optically, in my view, it looks quite good. The question is, I think, how much of a difference it's going to make really to the profits of Reliance. To begin with, it's going to be marginal. But I have a slightly larger worry. In all these years, Reliance Jio is still to begin defraying the capital costs of the entire project. And they have spent about 3.2 lakh crores, and that is defrayed over time. So unless we get a clear picture of that, I'm not too sure whether we should read too much into it. Let's not forget that Reliance is already a $110 billion company, so it's not a fleet-footed, low-price stock where you can expect some great returns. So I would believe optically, yes, in the short term, it looks good. You can get some trading profits. Long term, I would still wait to find out what is the kind of plan they have on the defrayment of capital costs.
Okay, Sangeet, what should one do with Reliance Industries now? Now, as a consolidated entity who has oil and gas, who has a lot of consumer thing, what should one look out for Reliance? Is it a good investment at this point of time, or you feel that the best is behind Reliance now?
So I would be cautious. I mean, overall as a group, if you see, I am concerned about their capital allocation policy. They have been acquiring content and companies, left, right, and center, whereas the other players are simply doing partnerships, which is much more lighter and capital efficient. Valuations also, it's not cheap, trades at about 18-19 times with a very high base. The significant portion of revenue now comes from their consumer business, about 25 to 30%. But majority is again because of the pricing indiscipline which they are currently sort of enjoying. And once the pricing rationality comes, that's the time we'll have to see how profitable this growth is going to be going forward. So I would remain cautious on Reliance.
Okay, and finally, today they announced that again they're looking to revive the KG D6 basin. Do you sense they haven't been able to do anything, and because of that, I think rather than them not doing, a lot of company went belly up because of the expectation of gas. You think something positive may come out of this KG D6, because that was the biggest thing that they had marketed few years ago, but that actually failed. Do you think any future in that?
Too speculative. I mean, could go either ways. I mean, very difficult for anyone to take a call whether it's going to be successful or not. But I mean, the way we would analyze a company is looking at their present numbers and present assets and the capital allocation policy which the management is currently having. And looking at that, I would remain cautious, I would say. Okay. I mean, I am no one to take a view on whether KGD6 would be successful or non-successful.
Okay, and Hari, what's your sense on Reliance Industries as a stock?
See, again, I think petchem refining, we are still comfortable, but I think, as I said, my biggest worry is there's a lot of money that has been sunk into Jio. Retail is, of course, much lower, but I think if you look at Jio, about 3.2 lakh crores is what they've already sunk in. And I think they could be sinking a lot more in terms of content. So, how is this going to be recovered? When is it going to be recovered? What is the going to cost of capital they're going to assign? What is the IRR of the business? So I think we need a lot of clarity. The initial euphoria is over, and now I think it's going to be a lot more of numbers. So we are cautious on the stock as a whole. Short term, as I said, yes, sentimentally it's optically looking good, but long term, I think there are a lot more hard answers they require.
Yeah, that's the view on Reliance. The other big company we want to talk about is Infosys. While most of the companies are not doing well, especially the mid-cap IT, which has gotten hammered of late, Infosys seems to be doing well. Both TCS and Infosys trading at a fresh 52-week high. What's the view on Infosys and what's working for Infosys? Agam tells us a snapshot on what seems to be doing well, what seems to be working for Infosys and not for some of the other IT companies. Agam?
Right. Well, Darshan, in an environment where we are looking at a slowdown as far as business is concerned across the consumption sectors, the nominal GDP growth stands at around 8%. Well, at least some investors out there are of the view that to take a bet on something like an Infosys would be a better option, considering not only does it have its pause in markets beyond India, but also the fact that its growth rate, in terms of expectations, has improved. Let's not forget that it has guided and increased its guidance in the last quarter for the entire financial year to around 8.5% to 10%. That's near double-digit growth, at least on the upper end. Now, among the few things that are working out for it is a robust order book, as we all know, and of course, digital services working out in favor. And as far as margins are concerned, again, the guidance of around 21 to 23%. In favor of that, we have a stronger dollar against the rupee, and we also have higher margin deals, especially again in the digital services business, which is aiding Infosys, and well, it's turning out to be a reasonably decent defensive play according to a lot of investors that we've been talking to.
Thanks so much for that, Agam. Hariyar, what's your view on Infosys? Do you think the rally will continue?
Yeah, I think a lot of things are going right, because the stock actually didn't go anywhere for the last, I think, probably 4 or 5 years, because they had this management churn, they had this top management changing, most of the senior people going in and out, corporate governance issues about the involvement of the original founder promoters. Their margins were lower than TCS, and they still continue to be. I think a lot of that seems to have turned around, or at least sentimentally turned around in the last quarter. I think after a long time, they have managed to upgrade their guidance, I think, which is what is standing them in good stead. Their employee churn, or the turnover ratio, I think, is finally looking to be under control, although still higher than TCS. And I think in valuation terms, it is definitely more reasonable than TCS. So I would believe that, we are probably at a situation where the entire trade could, happen to be a kind of a long on Infosys, short on TCS kind of a trade. And if you look at Infosys standalone, I would believe the stock still has some upsides, because it needs to make up for the last 4 years when it didn't do anything.
Sangeet, you agree? Is there more potential upside? Is the worst all the issues with promoters in terms of some related party transaction that happened with the earlier management? Is that now all behind? Is Infosys now looking at much better growth going ahead?
Yes, it seems to. I mean, we spoke about Infosys immediately after the Q1 results, and very rarely do we see Infosys upping their guidance in the first quarter itself. That already gave a lot of indication about what's coming ahead. The other, they also changed their capital distribution policy, upped it to about 85% of free cash flows. They kept the margin guidance same, but I think now with the currency in their favor, you might have a scenario wherein they might, up that guidance also in the Q2 results. Vis-a-vis, you have the other IT companies that were quite lukewarm. So I think a lot of money is clearly shifting from TCS to Infosys to catch up to the valuation differential.
What's your pecking order in the large cap IT, at least, let's say, Infosys, TCS, Wipro, HCL and Tech Mahindra?
So I like Infosys, maybe followed by HCL Tech.
Because of valuation?
Sort of, yeah.
Okay, that's the way. Hari, what's your sense on the pecking order of IT, the large cap IT at least?
I think it will be Infosys followed by Tech Mahindra. We are not too positive on Wipro, but probably after Tech Mahindra, we would put HCL Tech. TCS, I think we're just being a little cautious at this point of time.
And what's your sense on buying into Infosys or the large cap IT versus mid cap IT? Does it make sense to stick with the large cap IT, or a couple of quarters back it was the mid cap IT that outperformed? What's your trajectory?
No, very clearly we are going with the large cap ITs, because I think, like with all the mid cap stocks, even the mid cap ITs are facing a lot of pressure. And I think what we could see in the next probably couple of quarters is that they also have a smaller client base, and so they are more vulnerable to cycles. So our preference clearly is for the large cap IT stocks. Okay,
and what's your sense, mid cap or large cap? What are you recommending your clients?
Go with large cap. The flavor has been large cap sort of. So, but no, I mean it's futile to actually differentiate companies, especially the IT companies, between mid cap and large cap, because it is the opportunity in the industry in which they operate. So whether it is some companies are automation, cater to auto sector, or some cater to BFSI. So you'll have to evaluate based on that. Where do you see the slowdown? Where do you see the upcycle coming in?
Okay, that's the view coming in on Infosys. I think it's a consensus thumbs up, and the top pick for both of our guests. Somit is now back to tell us about why Shankara Building fell significantly after listing. It made new highs after the listing. then it fell drastically. Again, it's on the way up. So what exactly is happening here, Sumit?
So if you see, the issue price for Shankara Building was nearly 460, and since then it had touched a high of nearly 2,270, and then it saw a significant fall, and the share prices were as low as 248. Now there was various reasons because of this fall that led to this fall in the share prices of Shankara Building. Firstly, it was the falling margins, then there was the liquidity crunch that we had seen. Also, Kerala floods was one of the reasons why the share prices of Shankara Building had fallen significantly, and also a fluctuation in the steel prices had led to this significant fall in the share prices. But over the last 3 days, the share prices of the company have gained nearly 60%, and currently the share prices are trading nearly 417 rupees. So what is the company into? The company is into retailing and wholesaling of building and home improvement products. It has nearly 129 showrooms across southern and western India, and recently the company had sold its largest processing factory, which was supposed to address the liquidity concerns that the company has. Now the margins from this processing factory was on the lower side. So if we remove this business from the company's overall business, then the consolidated margins of the company is expected to move up higher going forward. And also the liquidity crunch that the company was facing would solve because of this sale of the largest processing factory. Now they have sold this factory for nearly 70 crore rupees, and in the last 3 days we have seen a significant share price rally on the for Shankara Building Products, nearly 60% rally in the last 3 days that the stock price has seen over the last 3 days.
Okay, thanks so much for that, Sumit. Sangeet, it's been roller coaster rides. If someone bought at the IPO, sold it at 2,000 very well, but if they are still holding it, they aren't making any money because it's still below the IPO price. What did you make of this entire thing? If you studied the company, are there any potential red flags that you're seeing, or you think it was just market conditions or stock being overvalued that caused all this movement?
So I have no view as far as the management quality is concerned. I mean, there have been some news going around earlier about questionable management practices, but I don't know, going by the financials, I couldn't find any, but there could be, because such volatility in stock prices is is kind of a smoke in the fire sort of, So I mean, you have a stock going from 300 400 bucks to 2,000 and then coming back, and then again in last week 10 days it's again gone up by around what 40-50%. But so let's again go by the numbers what we have, so very thin margin business, very low ROE kind of business. I think it does not have its brand of its own, so it's basically distributing products. And we have seen, especially in this decade, that companies or franchises only depending on pure distribution is susceptible for disruption. And when you have continued period of down cycles followed by a fairly leveraged balance sheet, then you will have difficult to live through that period. So I would remain very cautious in the company. Having said that, I was glancing through the shareholding list. There are a few marquee names as their shareholders, but still, I remain cautious on this particular space. The hardly 5-6% margin business with about 10-11% ROE business doesn't give me any comfort.
Okay, Hari, what's your sense on Shankara Building?
See, we would avoid any stock that corrects 80% in 1 year. So obviously there is. The way we look at it, there is no smoke without fire, and the fire, in my view, is coming on two fronts. The first front is that when Shankara listed about 2.5-3 years back, and the stock price started shooting up, the entire story was that here is a company that operates in building materials, but then it is somewhere between a building material company and a brand. So it's a building material company which will get the valuation of a brand. So that is a story that was sold. I think it emanated that there is no such story, and it is ultimately a building material company and will be valued like a building material company. So that is what I think the whole valuation implosion that we have seen. The second reason I think on Shankara is that there is a massive liquidity crunch, as we understand, and they are literally living from month to month. So I think that is not a very good situation for a company to be in. And with the kind of tightness we see in credit markets, I think problems could get a lot more acute. So we would typically stay off this company for now.
Okay, that's a view. I think it's a negative view that's coming in on Shankara Building. Both our guests are cautious on the one. And the last stock we want to talk about is the recently listed India Mart, India Mesh. Counter is doing extremely well in trade. It's moved up almost close to 30% or 25% in the last 2 trading sessions. So there is enough traction that's happening. Agam Vakil is here to tell us more about what this company does and why is this happening. Agam, what's the reason?
Right, Darshan. So India Mart, India Intermesh is an internet play in India, and as we all know that there are very few internet-based companies which are listed. So other than India Mart, we have something like perhaps a Just Dial or an InfoEdge, if you consider it. And even though they're not direct apple to apple comparison, they're all internet plays. Now, India Mart specifically is India's largest business to business marketplace, and it has about 60% market share in online B2B classifieds. It has strong brand recognition and market position according to a lot of brokerages, and a lot of investors are now starting to see that opportunity in India Mart. Of course, we all know how the listing's gone for the company, which happened back in July. After that, and after the kind of gains that we have seen very recently, since its listing, it's advanced by as much as 19%. The real question is, can it catch up to the likes of Just Dial, or for that matter InfoEdge, which are up by anywhere between 40 to 45%. And let's not forget that it has also considerably outperformed the Nifty 500 index, which has actually declined by as much as 2% on a year-to-date basis. So a lot of questions on the fact of whether or not there is further value in India Mart.
Thanks so much for that, Agam. Sangeet, I'll come to you. India Mart, firstly, a view on the company, and is this the best internet play? You have other plays like InfoEdge, you have Infibeam, you have Just Dial. Is India Mart the best play? What's your view?
Looks very interesting, I would say. If you ask me about a peaking order, I think I would rate somewhere InfoEdge and India Mart as one of the two. Infibeam, obviously, I don't have comfort on the management quality, and Just Dial business model, I think, is outdated. So talking about India Mart, I think great business. You have seen that they are now the leaders in B2B internet platform, and the market share above 50% gives them that comfort that they don't have to do any capex. If you see, they have hardly done any capex over the last 2-3 years, and whatever they are earning is actually free cash flows. So they earn actually about 250 crores last year. They have a healthy cash balance of about 750 crores. So very similar to the growth trajectory what Naukri enjoyed, the way Naukri built up its business. If you see, the EBITDA margin in the last quarter has practically doubled from 13% to 26%. And mind you, Naukri operates at an EBITDA margin of 55%. So it's a game of market share, and I think once you cross a particular market share, you're in for a ride. That's where I think India Mart is currently.
Okay, that's the view that's coming in. And Hari, what's your sense on India Mart?
See, frankly, there is not much of a track record to look at, because be it a price track record or an earnings track record, we have a limited track record. So I think we'll have to go with whatever little data that we have. But I tend to agree with what Sangeet said, that it's an interesting business model where the incremental investments are very less. And, we really don't have much of a choice as far as the internet companies are concerned. Just Dial has its own problems. Infibeam has its own problems. So essentially, it boils down to an India Mart, which is a sound, profit-making, stable company, and Naukri.com. So other than that, I don't think we really have any solid internet companies. The only challenge for India Mart could be how will they continue to, keep monetizing their databases and their networks over a period of time, which is what someone like Alibaba has done so well in China and across the world. So, whether they can replicate the kind of a business model of an Alibaba, but I think that is still some time away. But yes, if you ask me, does the model look good? I would say definitely looks good. And in the absence of too much of historical information, I would say the stock is probably an interesting stock to look at.
Okay, that's the view. So interesting view that's coming in on India Mart. It's a stock that should be on your radar to track what's happening. But with that, it's a wrap on today's edition of Hot Money. Let me thank my guest, Sangeet. Thank you so much for coming in. Thank you, Hari, so much for joining us on the phone line. Ask BQ comes up next. Stay tuned to Bloomberg Quint.